Good afternoon. My name is Monica Weissmann, and I am a senior financial advisor working on the platform of Manulife Wealth and a life insurance advisor working for Wealth Management by Monica Weissmann Inc. I have been in business for the last 24 years, and at a certain point in time, one starts thinking about retirement. It's not an easy thing to do, and actually, that thinking made me change my career and become a financial advisor because I couldn't find a good enough one for my retirement. But that's a story for another time. The biggest question when we think about retirement is, what is the number? What is the magic number? How much money do I need to retire? I want to tell you that the opinion presented in this webinar are mine and mine only. Any mistakes should be attributed to me and not to Manulife Wealth Inc. or to Manulife Wealth Insurance Incorporated. Having said that, I want to start with a series of very nice cartoons which were published recently in the New York Times. They are by Ron Lieber, and they have been published in the New York Times Magazine. How to make retirement scary? Retirement is scary because when we retire, we stop being who we were before. If we were an expert in payroll and we were consulting every day, a few times a day, we are not that anymore, and we are not consulted anymore. So who are we when we are in retirement? And especially, what are we going to do in retirement? We will have lots of time and maybe not lots of money. That depends on our personal tastes. The best thing is to try to prepare for retirement, and the process of preparing for retirement is a retirement planning, making a plan about how to spend the money in retirement, and then we can get to a conclusion about the number. Of course, the simple answer to the question of the number is it depends. Of course, it depends on your personal habits, on your way of saving money. How did you grow this money that you have accumulated? And whether or not this money will be sufficient to support your lifestyle in retirement. That's what I call retirement, smart retirement, planning for it, knowing if there will be any shortcomings, knowing how to deal with these shortcomings, and so on and so forth. Even if we build this roadmap and then monitoring it, we need to tweak it, we can do that more easily. And the feeling of security that you will have if you do that plan for retirement. So the agenda today and the objective of this presentation is to help you decide how you want to deal with your retirement planning challenges. You want to imagine who you will be in retirement and what will be your occupations or your lifestyle. You want to know, of course, what are the sources of income in retirement, and you want to establish a strategy to decumulate your savings versus the strategy of accumulation that you have been using before. Is there any possibility to guarantee what you will leave your family after you pass away? That's part and parcel of the estate planning, but maybe may be becoming also parcel of the retirement planning. And yes, that is not easy to do, but hey, this is my dream of retirement. I'm sure that it is, I'm not alone in dreaming like that. Hoping that everything will be good in retirement is not necessarily a strategy, and it's certainly not a good strategy. Now, we have looked at the feelings that different people of different ages, which are pertaining to different groups, uh, have about how much money they need in retirement. And obviously, those who are a little bit more senior, they have more, let's say, humble expectations, if we can call $1.2 million expected to be needed by anybody who is at the age of 71 and plus. We see that the younger people expect to need more, which is correct. I'm not sure about how correct is the number. So what the number is will impact how much money we will have if we are to live long. And long life today is much more expected than 20 years before, because of the advancement in medical support of our lives. We want to know how much money will we have and how long we can have that money, even when we start withdrawing money for our retirement lifestyle. We want to take into account the inflation, which is a given. It has not been very active in the last 10, 20 years, but right now seems to be and to be more sticky than before. And then what if something happens to us? We have to have access to emergency funds, and the best way to have access to the emergency funds, in my opinion, in my personal opinion, is to have a lot of credit which is not used and not normally used, that you have access to when you need. My personal preference is to have credit cards with available credit that I never use, or if I use them, I immediately cover them. That's access to funds for which you don't have to pay any money. And that will allow you to live beautifully the way you like. Now, if you are used to spend a lot, you probably will continue to spend a lot unless you create a budget and you become very firm about strictly adhering to the budget. Sir Isaac Newton said a body at rest tends to stay at rest, while a body in motion tends to stay in motion unless acted upon by an external force. That's what I had in mind when I was talking about budgeting and adhering to it strictly. But other than that, life is beautiful until you retire. 53% of the Canadian are sure that retirement is important, but they don't know how much money they will need and where this money is going to come from. Only 1 in 4 Canadians set aside money from every paycheck for retirement, and that is a much too low a number. So no matter how much time you have until retirement, you should continue to save until such time that you really retire, and you should probably try to create a retirement plan and see exactly for how long your retirement money will support your lifestyle. If we talk about sources of income in retirement, and that is a review of the things that I'm sure you know and you have heard about, a quick review will tell you that the sources of income in retirement may come from either the government or your pension plans in the corporation or personal savings. The government sources of income that we will look in more detail immediately are the CPP, which is a Canada pension plan, and that is a mandatory program for every Canadian that is working, and it is intended to supplement the retirement income. In general, the government benefits, the total of the government benefits are supposed to support the retirement income. They are not supposed to replace your all your sources of retirement income. Therefore, they have been for a long time calculated to be about 25% of what you need as income in retirement. And a few years ago, they have been improved and supposed to grow and support 33% instead of 25%. Coming back to the CPP, the normal age to take the CPP is 65 years old. All the income from CPP is fully taxable. If you take your retirement from the age of 60, which is the earliest time that you can do that, you will be sort of penalized because you will lose 0.6% per year of retirement income for every year that you retire before age 65. If you are delaying taking your retirement income, the CPP, for after the age of 65, you can do that up to the age of 70, and you will get a sort of a bonus recompense for this of 0.7% per year. Your retirement income forever will be higher by 0.7% per year for the next 5 years until the age of 70. Certainly, there is no need and no justification not to take the CPP, at least at the age of 70, as you cannot carry forward more than 12 months. If we look at the CPP in general, there was an expanded CPP program, and the maximum annual benefit has changed from 16,000 to almost 20,000. As I said, the CPP has been enhanced, improved, and also the contributions have increased at the time of these changes. All the money that we get from the CPP is included as income for the recipient in the year when it is received. Another government benefit, which is very important, is called old age security. It is federally funded. It's a social security program, and it comes based on your years of residency in Canada. You have to have at least 10 years to be paid any old age security. And for many of us who are immigrants, that's an important information because we will get a prorated benefit from the old age security, prorated by the number of years that we have been in Canada when we start taking the old age security, over 40. It's a guaranteed, there is a guaranteed income supplement for those who are having a very low income in retirement. And you can read more about this. Information is available on the internet. The earliest age that you can apply for the old age security is 65, and yes, you will be compensated by getting a bigger amount if you delay the OAS up to the age of 70. The GIS is dependent on your income that you have received the year before. It can be applied for and received and then interrupted if your income becomes too high for eligibility. There is a clawback possible on the old age security benefits, and that is for 2023, if you make more money than $81,000 and change, your extra money will be clawed back that was paid to you in the old age security. If you use corporate pensions to supplement your retirement income, you probably are part of one of the two possible pension plans. One of them is called defined benefit, and one of them is called defined contribution. And first of all, I want to clarify that there is a very big difference between the two, which is usually not well explained when the information about the two plans is presented. The defined benefit pension plan is one in which the companies contribute a certain amount of money to your pension plan, and the contribution is, the meaning of this contribution is that the company takes the risk of the market investment of this contribution. And if the market performance is not good enough in the defined benefit pension plan, the company is forced to complement the contribution in order to compensate for the market risks. In defined contribution, the risk is attributed to you. The company will contribute a certain amount and has no saying in what the market risk will be, because in defined contribution, you decide what will be the investment, so you take the market risk. And if the market doesn't perform as expected, that's too bad. The company is not liable to contribute more. Now, when we use one of these two pension plans, and when they get to maturity, you have a few income options, and we will talk about all of them, trying to compare and explain to you what are the benefits and the disadvantages. All the money that you receive and as income from a pension plan is fully taxable like any other income which comes from accounts which have had the taxation deferred for the purpose of growth without being liable for tax. But the taxman will always get paid, and there are ways to mitigate, which means to optimize, which means to minimize the taxation for this type of registered accounts. And the four ways to do that are pension splitting, CPP sharing, prescribed annuities, and withdrawal strategies, and we'll talk about each of them. The 3Ds for the tax planning are deduct, defer, and divide, which means take deductions to reduce your taxable income whenever that is possible in the years when you pay tax. Defer paying tax to keep your money working for you longer, which is what you do when you save money in RRSP or in TFSA, and divide your tax liability by taking advantage of income splitting. That's especially after you get into retirement. So the RRSP is a classic example of tax-deferred growth. It is flexible in the meaning that you can take this money out at any point in time, and you can take out any amount of money from your RRSP for any purpose. However, with the exception of two purposes, you cannot put that money back into the RRSP. Only if you take it for buying your first residence, or for changing or educating yourself in terms of getting more skills for employment. The RRSP is fully taxable at withdrawal, except these two situations that I mentioned, which will allow you to put the money back over a large number of years, 16 years or more, 10 years or more, 16 years for the residence and 10 years for the long life education. The TFSA is actually stronger than RRSP, in my opinion, in terms of flexible withdrawals, because not only it allows tax-free growth of the money that you invest there, but it also allows you to withdraw any amount of money that you want and replace it later if you come to be able to do that from the financial point of view. For example, if you invested $1,000 in your tax-free savings account and it grew to be $5,000, and you take out the $5,000, usually the year after you will be able to put back $5,000, not the $1,000 initially contributed. That is very powerful. I'm not sure that everybody understands the power of this flexibility. And yes, it's true that the contributions to the TFSA are made with money which is after-tax money, and the TFSA does not allow you for any deduction from tax, but the growth in the TFSA is deferred actually forever, because the withdrawals from TFSA are free forever. There are also a new type of savings for your first home, which is called HFSA, and I don't have information about it just right here, but if you are interested and want more information, take the coordinates that will be presented to you by the end of the webinar and contact me for eventually a free consultation that I'm offering, a complimentary one. The non-registered accounts are very important also for the income in retirement, because the investment income, the dividends that you get in the non-registered accounts, are actually taxed every year, even if you are not aware of that. If you use investment income from your non-registered account, you have probably paid most of the taxes. It is flexible from the point of view of withdrawal of the money. Any amount can be invested, any amount can be withdrawn, and the capital gains may be triggered for only the money that you have really redeemed in order to use. Now, when you do investments, and yeah, just one more comment. I think for those who have large amounts of money in registered accounts in RRSP or in Lira, in LEAF, it's very important to have a really balanced possibility of taking some money from either TFSA or registered accounts, so that not all the money that you use in retirement will be taxed. I want also to talk about the challenges of doing a retirement planning, and the challenges are the matters which cannot be controlled, i.e. the interest rates in the market cannot be controlled by us. Obviously, it's only the government controlling that. There are geopolitical risks that your investment will uh, will have to be able to survive. There are trade wars. We being the generation of seniors, people of the age of 65 and over, who are growing the fastest in all the world, including Canada, the US, or the rest of the world. Healthcare is in need of more budgets to support more people who are in need of healthcare in their home. And it's very important for the governments to find the budgets, but that's not something that we can really impact. Yes, we get butterflies in our stomachs when the market volatility manifests itself in our retirement investments of any kind, but we can invest in such a way that this volatility is diminished. However, don't think that this is a free for all benefit that can be used. You do pay for it. I just want to quickly show you that a chart, which I think is very important. But before we go into the details of the chart, let's talk about the rule of 72. And if not anything else, I want you to remember this rule after we finish the seminar forever. Because the rule of 72 is a quick way of deciding how long your investment will take until it doubles your money. In other words, let's say that you invested $10,000 and you want to know when will you have $20,000 from your investment. If you invested in GICs, and let's take the rates of today, which are 5% more or less for the year, or close to 5%, and you invested $10,000, and you divide the $10,000 by the 5% that your GICs are going to pay. So $10,000 divided by 500, the result is 20 years. It will take you 20 years to double your money if you are invested in GICs. Let's assume that you have invested in something else, and let's assume that the returns are higher than that. Let's assume that the returns are 7%. So you get $700 per year from your investments. Your investments will double in 14 years instead of 20. If you are lucky enough and you get returns of 10%, which is not easy to do, your investment will double in 10 years. So 7% was more or less what we were trying to get in retirement accounts always. And I want to show you how difficult it is today, much more difficult than 20, 30, 40 years ago, to get the 7% return without taking a higher risk. This is an official chart that I stole from the internet. It's documented where I took it from. And in 1993, if you took a little bit of risk, like a 6.2% risk, and you invested in US bonds, you could have a 7% return. But in 2008, which is 15 years later, you should diversify and invest not only in fixed income, which means US bonds, but also in stocks, which are the large cap equities, in small cap equities and developed and not developed countries. And the risk would have been much bigger by diversifying. You would have the 7%, but you would have a much higher coefficient of risk, which translated for you in higher volatility of the amounts of money in your investment portfolios. If we go another 14 years later, in 2022, which, by the way, was the most terrible year for me in my 24 years of experience in terms of returns, and you need to take a risk which is much, much higher and diversify much more, go into private equity, which is not easy to do and not easy to bear, into real estate, et cetera, and the risk would have been almost 17%. If you think about this, this is almost 3 times the risk that you had to take in 1993. And then this is last year. It was a little better than 2022. You could have realized the 7% by taking less risk, but still you couldn't be only in bonds and fixed income as you could in 1993. So in order to survive in our times with an effective retirement portfolio, we need to change the approach, and actually we need to build a portfolio in which you are invested for both income, which would be dividend investments and generate tax efficiency income, or growth-oriented investments, which would be stocks and limited volatility in investments that will grow. We will talk about this a little bit more because this is probably one of the major contributions to your benefit from working with a financial advisor, with a professional, in order to do and monitor over the longer term your income generated in retirement. You need to plan for the worst and hope for the best, absolutely, but you need to be sure that you cover your needs and also leave some space for the things which are not a must-have, but some wants, because otherwise, how can our retirement be golden? The decumulation strategy is actually a very different strategy from the investment accumulation strategies that you have been using most of your life until now, if you are, 10 years before retirement or less. The goal of doing the retirement planning is to ensure that you will have all the money that you need for your golden years, that it will be tax efficiently managed, and that you can leave some money for your family if you love them. Things that we cannot control are the sequence of returns for your investment accounts that you want to use in retirement. We cannot control the sequence of returns. The exact meaning of this is that if you retire today and the first year after your retirement is a bad year from the market growth point of view, that's very bad news for you. It's very important to be lucky and to have enough growth in the first year to create a strong foundation for your future retirement. Actually, my preferred strategy for generating retirement income in retirement is to create buckets of from the money that we designate for retirement. And some of these buckets would be for use in the next 12 months, and that should be in more or less non-volatile or low volatile investments, and then buckets for the next 3 years, which should include some or quite a bit of growth investments, and the bucket for the long term, which should include certainly majority of the investment should be growth oriented. The emotions that you will feel during the times of your investments for the retirement or in retirement should not get hold of the better you. You should be clear enough about your investment strategy and about your decumulation strategy so that you can hold on to your investments over thin and thick of the market's ups and downs, because uh, timing the market doesn't work. Only time in the market does. And I can guarantee this is absolutely correct from the experience of my 24 years in the business. You also have to monitor your retirement. Having good retirements for today doesn't guarantee that the same retirements are good for tomorrow, if tomorrow is 6 months later, or 12, or 36 months later. The investments that you have, especially the ones for your retirement, should be monitored. And that is something that many people maybe avoid to do, or don't do enough, or do too much. The tax efficiency in retirement is very important, and we'll talk about this a little bit more. Then the style of active management versus passive management, couch potato type of strategy, is that good for retirement and for which part of your retirement investments? What about comparing the performance of mutual funds and ETFs? That's all these tricks and tweaks of the in-depth insights. You can either learn them yourself from the internet, because there is lots of information and it is free, or eventually get yourself a very good advisor who will teach you while you work with him or her. This is a comparison between the accumulation and the decumulation. We always think that we have much and we spend little, but in fact, we don't have that much and we spend much more than we think. It's a fine line between not running out of money and being able to enjoy your retirement. And because you can't predict the future, that's why we have to prepare for the worst and hope for the best. We need to manage our retirement investment in such a way that we preserve the capital. The best possible doing is to decumulate not more than the capital that we have can grow in the same period of time. This way we can preserve the capital even if we take withdrawals. We also should manage the volatility to the limit that we can stand it and sleep at night. Your peace of mind is very important, and certainly the volatility should be managed even to the detriment of your returns if this is really bothering you. This may happen if you look too often at the at your accounts and you monitor them on a daily basis, because daily is very short term. 1 year is very short term, 3 years is a medium term, and 5 years or more is a long term for the people that live today. We have to have some investment invested for the long term and be able to keep our emotions in check through the volatility of the market. And we do have to have access to emergency fund, either through a line of credit secured by some real estate, or by line of credit secured by your credit cards. But it's important to have access to funds in an emergency. My personal opinions about retirement portfolio is that growth is more important than income, even for retirees. And what I mean by that is that we can sell some investments that have grown and generate income by doing that. And most of the times, I would say a big majority of the times, the growth will grow more over the same periods of time than income will. And that's because the income investments will have a lower volatility, and there is a price for lower volatility, the price being the growth that doesn't happen in the income investments. If this is not clear for you and you want more explanation about this, just check my coordinates and book a complimentary investment consultation. The tax efficiency is very important because a very big chunk of our money is taken by tax, and the most important thing is how much money we keep in our pocket rather than how much money we made if the money is to be paid in taxes. Don't you agree? There are specialty tools which can help with the retirement planning, and I strongly advise that you try to create a written retirement planning that you can monitor on at least an yearly basis. Very strong recommendation to hold on to your investment strategy, even and especially in the times when the stock market turns down. One of the main value added that I have for my clients is to help them go through that kind of times. And in the last 3 to 5 years, we had immense proofs that investments that seem to be unsuccessful and who even lose money in market value will turn around and reward many times the fact that you continued to hold them. In the times of high volatility of the market, it's a very good idea to implement the dollar cost averaging strategy, which means to buy for the same amount of money on a regular basis, be it monthly or bi-weekly or every 2 months, because that will reduce the volatility and allow you to achieve a unit price that would be lower than the amount that you would invest if you buy in a lump sum at once. Again, if this is not clear enough, sorry about the limited time that we have. Just book me for a complimentary consultation. Be prepared to use the access to your emergency funds if unexpected health expenses or extreme situations are happening. When we discuss the retirement planning, we will discuss the cash flow and the tax efficiency of the payments in retirement. when we discuss the estate planning, to differentiate that from the retirement planning, I do both, obviously. We do a calculation, a guesstimate of the liabilities that your registered account and non-registered account will have in the moment of your demise. If you have a cottage, if you have a business, you may have creditors and other debts, you may have taxes owing. We need to plan for that moment when you pass away, and the government considers that all your assets have been sold the day that you pass away. If you don't plan for that moment, the taxation may be not optimized, may be not minimized, which is the right that you have, and it would be too late to do that when you pass away. If you want to leave some money for your next generation, your children or your grandchildren, again, this is something that has to be planned ahead of time, and there are ways to guarantee that amounts of money are transferred properly with minimal taxation, and that even if you have heirs who are not spending properly, you can control that from over the grave. I was talking about guaranteed sources of income, and this can be the pension plans that you have guaranteed by your corporations, but they can also be annuities or segregated funds. Annuities is actually another form, another word for pension. And you can personally buy a pension. I put quote around the pension, which means you can invest a lump sum and give it to an insurance company who will commit by contract and will guarantee to pay you a certain amount of money every month or every year for your lifetime or eventually even longer. They will do that for your contingent annuitant if there is somebody who will inherit this annuity and or will pay the benefit to your heirs. For more discussions about these guaranteed sources of income, including segregated funds, which can guarantee either the preservation of the capital you want to leave or the preservation of the income that you want to leave, please book me for a complimentary consultation. The focus, and I am told that I should actually speed up if I let you ask some questions. So these were all my presentation slides for today. And you can get them if you send us your email addresses even after we finish the webinar. And these are my coordinates that you can use to book a complimentary presentation. Thank you very much. And Sasha, if there are any questions, I can try to answer them.
Yes, thank you, Monica. No questions at the moment. We'll just give it a few minutes. I will be just adding Monica's contact information on the chat for anything, if you think of anything after the webinar.
Is the chat available after the webinar?
No, your contact information will be there, so participants can copy it.
Okay. Okay, so I thank you, all the attendants of today or in the future. Please feel free to ask for a consultation. which would be custom-made for your personal circumstances. And I hope that this was beneficial to you, and as both a refreshment and maybe you got some new information or new ways of thinking about your income in retirement. And yes, you can do a retire smart plan, and it's very advisable, highly advisable, in fact.
Perfect. So since there are no questions at this time, I think we can finish the session.
Okay.
Awesome.
Thank you very much.
Bye-bye.
Bye-bye.